LA County Real Estate Association, formerly LARIC, Lloyd Siegel's program, and this is the official podcast, formerly Real Estate Investing Zoom. We get together every Tuesday at 3 p.m. Pacific time, 6 p.m. Eastern, and talk about all things real estate investing. And just real quick advertisement for the upcoming program. On the second Thursday of the month, every month, is the Vendor Expo, and it is in, we call it Culver City, technically it's Los Angeles area, but we get together live and talk about all things real estate. You see the little map. If you go to LAProbate.com, has the details. And there'll be about 250 people there and a speaker. And this month's speaker is Bill Tan, longtime Southern California expert on how to really structure deals. These guys should really help you if you're looking for deals and they don't quite fit the box, help you figure out how to do that. So he'll be there. There's a vendor expo. I'm one of the 50 vendors ahead of time, and we live stream that. So love to see you there. It's free, and details are at LAREIC.com. That's our official sponsor for our program. Really excited today. In the course of being a real estate broker in Los Angeles, California, I'm always asked by customers, do I have good investments? Do I have places for them to put their money? And second of all, I'm always myself looking to invest in money. I work hard on my business during the day, and I like to put the excess money that I invest to work. So I go to sleep at night, my money's working, and on the weekends and vacation time and such, and building. And that's what we call passive income. And so really, I saw this lady give a presentation and fabulous stuff. And I'm looking at her as well as an investor perspective of myself, as well as want to introduce her to my friends and family. And so here we are today, Whitney Elkins-Hutten. Welcome to our call today.
Thank you so much for having me. It's a pleasure to be here.
Now, I know that the website that you're associated with is passiveinvesting.com. Is that the formal name of the company?
Yes, that actually is the name of the company. It's passiveinvesting.com. What do
you guys do?
Right?
Passive investing. What do you do?
Right? Like, there's no question on what we do. But yeah, we're a private equity firm out of the Southeast. We're based out of Irmo, South Carolina. And for those of you who don't know where that is, it's right outside of Columbia. And, we specialize
for Californians, that's between California and New York or Florida. There's some space in the middle there called the central part of the United States, and it's there in South Carolina. So go ahead. I have to explain that to my California friends.
Yeah, so total opposite seaboard. But yeah, we strive to invest in hard assets, in real estate, commercial real estate, and assets backed by real estate, in order for our investors to generate passive income now and long-term wealth build for themselves and future generations. And we specialize in multifamily, self-storage, car washes, hotels, and first position lien real estate debt. And we strive to get B plus, A class assets for our multifamily and self-storage. We tend to stay away right now in this particular cycle. We're staying away from the the deep value add type strategies. But anyways, that I don't want to go into a complete pitch on this sort of stuff, but that's what we're helping our investors do, is take advantage, not only creating investing in assets that have capital preservation, but they have cash flow now, they're stabilized, long-term equity build. So we can pull, forced appreciation levers. We can, take advantage of natural market appreciation. And then also take advantage of pass-through tax benefits, which right now is the end of 2022. Many of you, I'm sure, have probably done really well this year, probably extremely well in the first half of this year. And if you're looking to, as a real estate professional, looking to build your kind of golden bucket of losses, this is the great time to do it, because this is the last year for 100% bonus depreciation.
Now,
so
look,
we
you're a
do
real
have
smart
assets
lady.
that are open.
You're a real smart lady. You cover a lot of stuff there. I'm a simple boy from a suburb of Los Angeles here, so I got to slow this stuff down a little bit for myself. So let's break it down a little bit. So investing with your company, are people investing in individual projects, or is it a fund, and your fund is investing money in various projects to diversify?
Yeah, we really believe that the investor should be in control, especially the passive investor, on what they're investing in. And the three ways they can get control is by selecting the operator that matches their goals, investment goals and risk tolerance, selecting the market they want to be in, and then selecting the deal. Now, with our multifamily assets, they are single asset entities. So we're taking, and we're buying large institutional grade assets. Our most recent one, we have two closings right now. One of them is about $80 million. The other one is like closer to $40 million. And we're putting those in each in individual LLCs. So you actually, as an investor, can select which one you want to go into. And there's a different reasons to go into funds versus not funds, but I like to actually not have things blind. I want to see what the asset is I'm investing in and make that choice for myself. With our self-storage and our car washes, we will group them into small portfolios because you guys, help people buy real estate. It's just as easy to take down a $1 million asset as it is a $10 million asset, right? Same thing with self-storage and car washes. If you can group like 3 or 4 of them together and, take down a $25 or $30 million portfolio as opposed to like a $5 million individual asset, that's the reason why we do that. But those portfolios, are largely visible to our investors. So they get to see the assets in the portfolio before they actually invest with us.
Got it. So, and then you mentioned the golden bucket of taxes. So as somebody who's enjoyed that golden bucket, I enjoyed it last year. I'm not set up to enjoy it this year. Describe it, and maybe I will if I find the right deal here. Tell me about that golden bucket and how that would offset my income with some tax losses now that will offset in the future, hopefully.
Well, yeah. So, even if you don't have real estate professional status and you can't unlock the passive losses, one thing that real estate has is that you can accelerate the depreciation on an asset through cost segregation analyses. So, okay, let me back it up. You've got your straight line depreciation. Let's just take a multifamily asset. It depreciates over 27.5 years. You can do a cost segregation analysis, hire an engineer, they go and they break apart all the different components of the asset, and they will accelerate whatever will depreciate in 20 years or less to the first 5 years of the hold. You're not changing how much depreciation is taken, you're just changing when you get to take it. So you can so if you can fast forward depreciation to the first 5 years of the hold, you've got now buckets of losses building up. Well, in 2017, with the Tax Cuts and Jobs Act, instead of spreading out that accelerated depreciation over 5 years, you can now take it all in year one. It's called 100% bonus depreciation. And that is phasing out over time and will entirely be gone unless something changes in 2027. We still have accelerated depreciation, okay? That's not going away. Just we lose the bonus depreciation.
So just to share from personal experience, so last year, just to use an easy example, I did a investment for multifamily of $50,000 in a particular fund, particular investment fund. And while it was a light value add, it wasn't a big rehab, because of the cost segregation analysis, they took the depreciation that might have happened over 1/27th per year and figured out that they could put a lot more in the first year. And so I got a $41,000 loss on paper. In reality, they made a small profit, but it was offset by these losses. So on my taxes, I wrote off $41,000 of other income, and I'm in real estate as a professional. So basically, whatever my income was went down by $41,000, which the tax rate on that money was probably 40%. So the nice thing for me, or for an investor, especially in the business, is you always look at investments and say, well, what kind of return will I get? 5%, 8%, 10% more. But if in the first year, in this case, just on the taxes, I got about 25%. No, that's not quite right. I got about a $15,000 and about 30% return in the via lower taxes in year one. So even if money was lost, at some point I'm kind of almost whole, almost out of the gate, or limited my exposure dramatically. So the tax consequences are a big benefit, but you don't want to buy something that's losing money. You want to buy something that's making money, but gives you the tax loss in the opening years, and then in the out years, you're gonna have to recapture that.
Well, yeah, and thank you. I mean, that kind of connects some of the dots. And then one of the powerful things that you can do that you have available to you is to 1031 exchange. So because the natural next question is, okay, great, we've accelerated things to the first 5 years of the hold. What happens at year 5 when large bucket of losses has been consumed, if you weren't able to take it all in that first year against other active income, well, we look to reposition assets in that 5-year time frame in 1031 exchange. So we are deferring the capital gains as well as the depreciation recapture, and essentially place a monopoly trade up. But what that does is that new asset, guess what you get to do? You get to take another round of depreciation on the asset. So that's when it becomes the golden bucket. And if you're doing this each year and offsetting, investing in, a passive asset or a real estate asset where you can do this, build up that big bucket of losses, you can potentially not or significantly reduce your tax bill. And especially like for you guys living in California, and that's huge, because not only do you get the federal tax savings, you also get that massive local state tax savings.
Yeah. Yeah, the California state tax thing is a whole thing. So,
it's a thing.
So I don't know if you've heard, but there's been some changes in the economy. Interest rates went up quite a bit. How has that affected your current portfolio, and how does that affect your, perspective, looking for new deals going forward?
Yeah. So I'll start with our current portfolio. Our assets that we're acquiring today are private debt. They have fixed interest rate loans for the term of the hold, and if not longer. So we have a great amount of runway, pretty boring investments, so from a lending perspective. Some of the assets over the past 2 or 3 years that we've acquired have what we call a 3-1-1 on them. So, short-term interest rate debt, and then option to purchase 1-year extensions. So you coming in now, you would not see that type of lending and that, on any of our assets. Now, what we did in that case, we've always had the what if, right? What if something happens, right? This economic environment we're not going to roll the dice and pretend that would never happen. The interest rates would never change. So we've always purchased a cap, and we've purchased those extensions up front. So again, we are locked, on how far that rate can float up on us. So that's always been in place. Now for future, it does affect the pipeline a little bit. Especially on the multifamily assets, because we're still seeing a huge amount of cap rate compression, and sellers still haven't really oriented to the new. I think they're beginning to orient to the new environment, the interest rate environment. So we're seeing a little bit of slowdown in that pipeline. We're okay with that because we're getting positioned, because a lot of those people that bought property in 2019 with short-term debt on it, guess what's happening here towards the end of 2022, Q3, Q4, 2022, their interest rate is going to start to adjust. They're no longer going to be able to hold on to that asset if they didn't foresee to purchase a rate cap or purchase those additional extensions. So we're getting primed.
So you covered a lot there. So let me again, I'm a little slow, so let me break it down a little bit.
No, I'm from Colorado. I talk fast. So
I talk fast. I'm not as sharp as you are. I'm not as smart as you are. So I'm just a caveman real estate agent. Anyhow, so you talk about interest rate caps. So one of the things to look for when you get an investment is what's their scenario. If they're going to do a value add, usually they'll borrow some money on a short-term basis with a plan to fix the property up. Now it's a higher income, refinance it into more desirable longer-term debt. But if the rates have gone up, they might be caught in the middle. And so what Whitney's saying is that they had bought what are called interest rate caps, which were available. I don't think they're as available now as they were a year ago and 6 months ago and such, so that they're protected. So you want to check that. And that way, at least they've done their best to prepare with the change. And then going forward, what she's saying is there are people who had a property, let's say they bought 5 years ago where rates were at 3%, and now their 5-year fixed is refinancing at 6%. The numbers may not look as good, and they might be interested in selling at agreeable terms. That's why investors should be getting their cash ready and lined up, and find the people you want to play with to be successful with that. That sound about right?
Yeah, but even, just think about it, even on those value add properties, using that bridge debt, they don't even have to do a refinance. Even just the cap expiring on that bridge debt, can be very problematic for a lot of investors or a lot of operators.
I heard one of my coaches is Grant Cardone. He's also very active in the multifamily space. I heard him say he thinks the companies that sold some of these cap insurance policies are really going to be under pressure. That, it's kind of like back when the mortgage thing fell apart. It's not the lender, it's the people who guaranteed the lender that were under stress. And I can imagine, because he was really checking those interest rate cap companies, that there might be companies there that, and he, as he said, we'll just have to raise some money and cover the gaps and be ready to do that. And there'll be strong players who will do that, and they'll be uncomfortable, but they'll do it. And there'll be weaker players who will miss that. Any thoughts on that? Is that something you've heard as well?
Well, I mean, I think, that is not my area of expertise, on the debt markets, but that definitely seems reasonable. I mean, we're actually in conversations right now with operators who know that they're going to have issues here in the next 6 to 8 months.
Wow.
Now those operators are trying to already transition out of these properties and do what they can, because, if we're going to bail them out, we're, I shouldn't say bail them out, but like, if we're going to come in, we're going to want to have it, and we're not going to overpay for the property, and we want it to be advantageous for our investors.
Right.
But yes, there are going to be operators, what's the saying, when the tide goes out, you find out who's swimming naked. So
that was true with all the crypto.
Tide's starting to go out.
That was true of the cryptocurrency, right? The tide goes out, and all of a sudden this guy, then that guy, then this guy, and it seems to be continuing. And who's left? Of course, when the tide comes back, those who are left are much stronger and do well. And so that's why it's such a good. I've said continuously for 3 years, it's been the best time ever to invest in real estate or build a business in real estate in my career. And I think it's still true, because there's still more money around than ever before. And I think that the world is just so uncertain that if you can find something that you're certain about and sell it, people are flocking to that. So I don't mean to make your job sound easy, Whitney, but it seems to me if you have a good track record and good program and good people, I'm sure it's hard work finding good deals, but when you do, I'm sure you have more success than the average bear on getting these things invested.
No, I would 100% agree. I mean, capital has been plentiful in the past few years. I mean, it's been easy, from a liquidity standpoint, even to get lines of credit. I've seen some of our investors, open up lines of credit or secure life insurance policies and invest those. I think, right now people are nervous about what's going to happen with the recession. How far is, the Fed going to go with raising interest rates? What kind of damage are they going to inflict on the markets? We've had some investors, that have had issues with liquidity, trying to get some of their money out of the market. Not that they can't liquidate stocks or anything, but their stocks took a nosedive here back at the end of August and September. So you just see a little bit more hesitancy and cautiousness. And honestly, I really feel like we're level setting back to the exuberance is kind of like flooding out a little bit. So I think we're kind of getting back to more of like sane investing times.
Yeah, I think it's healthy. As a real estate broker, I would say, a monkey could sell a house a year ago, and sellers would, compare me to a monkey and hire the monkey. Now the monkey has a property in the market and it's expired. They don't know why. They never really sold the market where you had to actually know what you're doing, and that's what separates professionals from the wannabes. So. And yet you put the work in, there's opportunity for success. Let's talk a little bit about where your products are. I know you mentioned that you're in South Carolina. Where are the investments that you guys, is it strictly South Carolina? Is it national? What's your footprint look like?
Yeah, we like what we call the Smile State. So, from a multifamily standpoint, we're in the Carolinas, Florida, Texas, Tennessee, and Georgia. Self-storage, the similar markets. We'll add in Colorado and Idaho on top of that. And then hotels, we're looking in those, southern metro areas, as well as our car washes. Now, the car washes are a unique opportunity because we are actually buying up mom and pop locations. We're specifically focused on the express tunnel car wash. And we're also building out the first third-party management company. This is one of the reasons why you've never heard of big money getting into this space, because there's no third-party management. They're not in, these REITs are not in it to own, to operate a car wash. So, we've focused on just that core area, and, where our home base is. We've probably picked up 17 within 2 or 3 hours of our home office. And now we're looking to expand that brand further inland to the interior of the United States. So that's a really interesting brand opportunity, because we're looking to scale to 100 or about 250 to 300 locations, and then IPO the company. A secondary exit to that would be to roll up and exit to a large REIT. And we can do that because we've built our own third-party management company. We own it. And then, we have our standard exit, which would be piecemealing, in small portfolios to other private equity groups.
It's interesting. It's consistent with everything I've seen in my lifetime, where at one time everything was local, and now more and more businesses are national. More restaurants by percentage are becoming national chains. More, even what look like local brands are really rolled into national chains. Grocery stores that have local brands like Ralph's are part of Kroger, and auto repair companies, tire places and oil change places. So it makes sense. There's no national player in car washes. I don't want to let the cat out of the bag there, but it sounds like you guys have an interesting run on opportunity that just the market would seem to be begging for. Interesting.
Yeah, from direct ownership, there's no other player. There's a few other, franchisees that are in this space, but they don't own the land and they don't own the brand. And that is a big issue when it comes to actually, being able to manage the profit and loss statement of a car wash, as well as position it for an IPO. Right. You have to be able to manage it end to end. Franchises, I think, are great, but they do have some flaws in that model. And conversely, I'm sure somebody could say some direct ownership is expensive and it's cumbersome to do, but that is we think it's the most conservative way to build a portfolio like that.
So let's talk about your clients. What's the range? I'm sure you have a range of brand new investors to experience. Is there a focus, or is there a fat middle for you as far as what your most common or what you target as far as your investor portfolio or profile?
Yeah, majority of our investors, they fall in a couple of different camps. But there's a large swath of investors that are exiting out of real estate, and they're looking to not be active. They want to fire their property manager. They want to fire Home Depot. So they're looking, to continue to exit out of their properties and move into more passive investments. And then we have, our high net worth earners, like real estate realtors, and that are looking to take the high income that they're earning with the highest and best use of their time, and start setting up a passive streams of income for themselves. Maybe it's a retirement avenue, but moreover, we're seeing more and more realtors and high other income earners, say like in law and doctors and stuff like that are just looking to kind of exit out of their sole proprietor businesses. And so those kind of make up the combined camps, probably make up about 50-60% of the people that we work with. And the other camp are newer investors that are just like, I don't really believe in the stock market anymore. This is, it seems like, Wall Street casino, there's got to be a better way. And so they just don't have the time or the energy to build their own real estate portfolio, but they're really attracted to real estate in general, and they understand the core benefits of real estate. So there's no reason, nobody gives you a gold star or a diploma for going and buying your own rental property yourself. So if they have the income and the net worth, we can work with them and help them place capital into these type of assets.
Now, real quick, we live stream this onto YouTube and Facebook, and so on YouTube, West and Coast Realty Partners says, Bill is right. Bill is always right. So thank you for noticing that. I appreciate that.
Bill's right.
Exactly. And he says getting started in self-storage niche, which is one that you're involved with, in car washes. And so it sounds like you might be interested as well, or she. And then boring businesses for the win. I don't know boring businesses, but I would say, when you take something and can scale it and modernize it and make it more manageable. That's, I think, where the opportunity is. In that's probably what you guys are doing with the car wash, right? It's running car wash is very hands-on, very labor-intensive, but you have modern management and methods and inventory controls and things like that. You can create some efficiencies over a larger scale business, I would think.
Oh, absolutely. I mean, you essentially have your in-bay DIY. I mean, that's where you drive your car in and you drop in your coins and you scrub your car. And then you have the in-bay that are attached to automatics that are attached to, say, like gas stations. You can only get 1 or 2 cars through at a time. And then on the other side, you have your full service car washes. So maybe you have a 30 or 40-foot tunnel and you can get 10 cars through. And then you have an army of people vacuuming your cars and wiping them down. Those are very labor intensive. We're very focused on that express tunnel model. So we're looking at tunnels that are like at minimum 80 feet, to 120, 130 feet long, to where we can wash probably 400 or 500 cars a day. Wow. And then, so not only the efficiencies that we can create operationally in the business, and we can run that type of business on 2 to 3 full-time employees. I mean, so very, wow. Labor is your number one controllable expense. Conversely, we can also add on top of that, like you said, Bill, the technology piece. So we're moving, the customer from, individual pay to subscription model. And, much like, that's essentially what you're doing with, self-storage and rental real estate. You're subscribing monthly or annually, whatever your lease says, but we're putting our customers on a subscription model so we can, stabilize the income and also, actually increase the income on these particular properties.
Wow, exciting stuff. Hey, guys, feel free to ask questions. The whole purpose of this program is, Whitney and I can have this conversation, record it, put it online. The purpose is to interact and give you a chance to ask questions. If you're sitting there thinking you have a question for her, this is the chance. And if you have that thought, somebody else in the call does, or somebody who watches replay will. So feel free to raise your hand in the Zoom box or put it in the chat box. If you're watching on YouTube, I saw Western Coast Realty likes my comment. Yes, I'm always right. Feel free to put in the chat box as well. And even if you're after a recording, I'll circle back if need to be, get back to Whitney as well. Whitney, I noticed your website at passiveinvestment.com, not to be an advertisement, but frankly, as an interested prospective investor, you have a join the Passive Investor Club. What's the Passive Investor Club?
Yeah, so that's just the opportunity for people to get onto our deal list. You can also get masterclass invitations with me. I do a weekly, YouTube show. It's also converted into a podcast, but, I talk about all things passive investing. And for those people who attend live, I do an Ask Me Anything session at the end. And then you get on our newsletter, and then you get notified of any of our open deals. One of the questions that I get quite often, and maybe this will kind of like spark some additional comments in, the feed, is especially from realtors. I've talked in front of a few different realty groups. They're just like, well, why would I invest passively if I can go find my own real estate, right? Like, I can then earn the commission myself, right? Well, yes and no. I mean, one is like, what is your goal? Do you want to constantly be actively buying and selling real estate? Do you want to actively manage the real estate? This is an opportunity to kind of shift that linear income into residual income. Two, maybe you sell, maybe as a realtor, you sell multifamily buildings, but you want to get exposure into self-storage or into hotels or into car washes. Do you have the time and energy and know how to become an expert in all those spaces? This is where investing in any passive investment can actually help you diversify your portfolio into different asset classes without having to spend all that time and brain power.
Yeah, I fall in the category, right? I have an active business here in Los Angeles. Occasionally, I find a deal I would invest in if I could turn it over, but we're not in a very tenant-friendly area. We're not in a very business-friendly environment. And so for me, I would only invest out of state, and I would need experts in other markets to help me. And so it's a natural, I can make good money here, but I have excess capital. I don't want to be a landlord in Los Angeles. Oh my gosh, no.
Hey, Bill, I wanted to jump in with a question if I could.
Sure, Paul, go ahead.
Hey, hi, Whitney. My name's Paul. Hi there. Nice to meet you. And
Nice to meet you.
I saw your website and I saw your YouTube videos. And what I wanted to ask is because I got into multifamily apartments about 2.5 years ago. At what point did you decide that you wanted to scale using syndication?
Oh, for me personally, um,
Well,
for me,
you started, if I understand right, you first started with your own deals at first, and then you scaled your business by syndicating. You had a comfort level at some point that, hey, this makes a lot of sense. I already feel that way now, but I'm curious at what point did you feel like, oh, this is the way we're going to start, to scale our business because this makes more sense, right? So
yeah. So just a little bit of background about me, and just kind of catch everybody up to speed. Is I started off in real estate completely by accident as an accidental landlord in 2002. I was living, flipping, and house hacking. I did that for a few years. So taking advantage of the 121 exclusion, which is kind of like the 1031 for investors. I was doing that with my private residences, and then transitioned into buy and hold real estate. So instead of flipping it, I started holding it and putting tenants in it. And then I had a ceiling of achievement, 30 properties, and I wasn't financially free. I wasn't where I wanted to be. And my husband and I kind of looked at each other and we're like, do we really have the time and energy to go to 80 properties, with single family? And that's when no, and I'm Bill. Yes, Bill's right.
right.
No, we didn't. We
Yeah.
had like a young child at home, and then I was taking care of other family members. So we did two things at that time. One, I sought out partners to actively understand the syndication industry. Yeah, and then two, I started investing we were getting tons of capital, cash flow and appreciation, equity off of our current holdings. And so I wanted to invest that passively. And I discovered something over the next couple of years while scaling up an active multifamily portfolio. I learned that the best return on my time was actually investing my money passively, and I was more diversified. Now, I do enjoy the active syndication, being an active operator. I do enjoy that. But I would say where my financial freedom actually comes from is from the diversification of my passive assets. And it allows me at any point in time to be able to say, you know what, enough, like I'm good. And I can, kind of ride off into the sunset. But my portfolio still produces cash flow. I still get the tax benefits. I still have, it's still, appreciating. But
So you kind of did it. It sounds like kind of like almost out of necessity because you were pulled by your day-to-day operational property management responsibilities to such a degree that it was stressing every other aspect of your life balance, so to speak. And you just felt like, whoa, I'm totally overwhelmed with property management. That wasn't really the goal.
I wasn't even property management. I was asset managing those properties with the property manager. I had the help,
Got
right?
it.
It would that we kind of hit a ceiling of achievement, right? You either need a person or a process whenever you hit that type of ceiling of achievement. And we had to sit down and say, do we really want to start hiring help with building out a single family operation? Or are we actually after the outcome that this is giving us? And I think that's where a lot of people actually miss when they build their business. They get attached to the identity that I'm a single family investor, or I'm a multifamily investor, or I'm a self-storage investor. And then they miss that they actually aren't that. That's not their identity. They're actually after the outcome that investing in that gives them. Right.
Yeah.
And so, I can look back with 2020 vision and say that that's what we were struggling with at that point in time. But I'm not a single family investor. I'm a mom. I'm a wife. I homeschool my child. Like, that's what I do. I was after what the power of those assets, what they could give me, which is, financial freedom, time freedom, choice freedom, location independence, and the freedom to create an impact, to be here with you guys.
Sure. So, and it said from your website it was only a few short years. Can you describe, are you talking about like all of a sudden 2020, 21, like during COVID, or like, is that like when all of a sudden just things kind of took off for you guys, or?
I love marketing. I'm a 20-year overnight success.
Me too.
But I would say, it's like a hockey stick, right? And a lot of that wasn't necessarily the repositioning of our assets, is that our real heavy mindset shift came in 2016. And when I was able to step into that mindset shift, that's when the hockey stick curve took off. I had to get out of my own way of what I really wanted.
Yeah.
Right? Like I was terrified. Of trying to find another 40, 50, 60 single family properties and what that would do and what kind of business that would scale. That was not what and I was just like, why am I so terrified? Once I finally kind of dug into that and, answered my own fear, my question, then,
Yeah.
things kind of took off from there.
Cool. Thank you.
Thanks, Paul. Great seeing you.
Yeah, you too, Bill.
Yeah, sometimes you be careful when you want to scale. The other challenge is, it's one thing to duplicate what you've done, but sometimes you lower your standards as you try to increase things, and then things can really spin off the wheel. So be careful. We did get a question on the YouTube again. What advice would you give somebody who's looking to start in one of these niches? Now, obviously, I think there's an obvious answer. If you wanted to start investing in public storage, you would invest with a company that does public storage. Or if you want to start in investing in car washes, why not start with somebody who's already done it and look at their numbers and learn from them? They're taking your money. You can't, I'm sure there's disclosures where you can't just copy everything they do. Some of the things are privileged, but for the most part, you can learn the business. I always feel like the best way to start any business is learn from somebody who's doing it at a high level. What would you, I think that sounds like what you did actually. You invest and kind of learn that process
exactly
yourself.
What I did.
Yeah.
That's the beauty of real estate. It's a repeatable model. There's very little of it that's proprietary, right? When you're talking about the transactional piece of real estate. Now, marketing, branding, and all that, yes, there's intellectual property there for sure. Now, but what I did is I actually invested in other people's deals with the intent of learning, getting paid to learn. Right. Now, a lot of people would be like, whoa, throwing 25, 50K down on somebody else's deal, that's not getting paid. You're still writing a check. And I'm like, yeah, but I get to see all the I get to see the whole offering memorandum. I'm free to ask all the questions on the due diligence. I can see the underwriting. I can see the communications, how they're handling the legal, how they're handling the taxes. And then I get to see, I get the distributions monthly, quarterly. I prefer monthly personally. And then also I get the exit. So you do get paid to learn. I mean, as in there are other ways to learn. There are, kind of the guru courses and stuff like that out there, but I like, kind of the more hands-on, tangible investing as a way to learn.
Well, I always feel like you have to believe in the process and become better. And so, like as an investor myself in multifamily, as a small investor in big projects, like you, I get the memorandums, I read them. I learn a lot by reading what these guys have. Like you guys have $1 billion under management. I read your documents. I'm going to learn a lot from you guys. You're not charging me tuition. You're taking my money and paying me back a return for my investment. So why would I not? And I think so many people don't take the time to look at those documents, and they're really giving you all the textbooks for free. And usually have somebody like you available to answer questions, explain this stuff, right? That's, I think, primarily one of your jobs is explaining these documents and these procedures so that investors are comfortable. I mean to pigeonhole you, but I think within the passive income company, that's your primary focus is education, correct?
Exactly. Yes. So I see my job as, leading the investor, meeting them where they're at. We have some very savvy, sophisticated investors that have been in 50 deals. They just may need me to ask, answer one or two questions specifically about our company. And then we have, the investor that knows nothing about passive investing. And I'm really there to kind of match where they're at and, lead them along the way, to help them understand their goals, the risk tolerance of investing, and then just the actual mechanics on how to get invested into a deal.
So if we want to get started to invest before they write a check or expect to write a check, they would learn about you and your company. The first place they would go would be passiveinvesting.com. And once they learn about you, on the top right, you have the join the club. So what would they expect? They're going to email from you and get invited to your webinars, or what would the next kind of steps look like? If somebody said, "You like to invest, I like to learn about you," how does that process happen?
Well, I'm actually going to drop another link in there. This is a subpage, passiveinvestingwithwhitney.com. If you go there, that you'll actually get connected into my landing page within the passiveinvesting.com ecosystem. It's essentially passiveinvesting.com/Whitney. But if you go there, you'll get an ebook that in a checklist that'll walk you through, they answers probably like 80% of the questions that new investors have about passive investing. You'll get all the notifications on the masterclass that I do. You'll get all the notifications of our deals, but you'll get put directly on my schedule. If you'd like to, talk with me about what it is we do here.
I did that. That's how we're here today. That's exactly what I did. And then I saw your YouTube, and I saw a webinar or two that you did, and here we are, and want to learn more. And I think sometimes the other thing I would tell everybody who's watching this is, this isn't about a transaction. You see her, you go to the website, you then either write a check or you don't. It's a process. And I've seen her since at other calls and learn and watch and look at their product over time. And so it's a process. It's a relationship you're looking to build. And so I want to encourage you to take the step. And I gave you the wrong link. The right LinkedIn is passiveinvestingwithwhitney.com. And that takes you to her. And then from there, if you hit the YouTube, take her to the YouTube that she did and some other resources with Whitney particularly. Great.
Yeah, but you hit the nail right on the head. I mean, as a limited partner, and that's what we are, the general partner and limited partners are partners. And so, my job, and part of my job is getting to know you as an investor, what your goals are, your risk tolerance, making sure that we're a good fit, to be in partnership for 3 to 7 years on a deal.
Wow, for people who haven't been married, that's a big deal. Now I've been married 36 years. So, for some people, 3 to 7 years is more than anything they've done and committed to their whole lives. It's a big deal to make that kind of investment. Tell me about your qualifications. Do you have accredited investors only? Do you have for non-accredited investors? What's the minimum investment range to get started with you guys?
Yeah, so our deals currently open right now. We have 2 multifamily, 2 car wash deals, and a self-storage deal all open before the end of the year. So if you're looking for that end of the year kind of tax, to get tax advantages, tax benefits for 2022, those deals are accredited only. And so I'm happy to go through what that actually means, if it's a term that we're unfamiliar with here.
Well, basically, you have to qualify for it financially, and you have to basically have certain income and asset requirements, and then you verify that process as well.
Yeah. So, and we use third-party verification. So we require third-party verification. And this is a Security and Exchange Commission's requirement. It's not us. For us to be able to operate under what we call the Regulation D exemption with the Securities and Exchange Commission, they require us to make sure all of our investors are third-party accredited, verified accredited. And so that means you have $1 million in net worth outside of your primary residence, or you have earned $200,000 a year individually for the last 2 years and reasonable expectations going forward, or $350,000 jointly with a spouse or spousal equivalent for the last 2 years and reasonable expectations going forward. Or you have like a Series 7, 65, or 82 license that can also work as well. That's kind of like the education qualification, if you will.
Got it.
So we are excited here in the future to bring on a Reg A fund, which would allow sophisticated investors to invest alongside our deals with our accredited investors. We're still, a few months off from being able to launch that. We're back in, got the final legal documentation with the Securities and Exchange Commission. So that should be coming soon.
those are the people that the cryptocurrency people avoided because they were too smart. So
It's not cryptocurrency.
exactly. So and then for accredited investors, what's the minimum investment requirement?
Yeah, so it depends. It's really deal dependent. Generally between $75,000 to $100,000. However, I am, open to having a conversation with any investor, and we can land on what that number works best for you, and see if it will work.
Got it. Great. So, okay, if you want more information, passiveinvestingwithwhitney.com, place to go, sign up, get in a conversation with her, see her programs. If you're not yet accredited, what a great goal to make it so that you can become accredited to invest with them. And then once you're accredited with them, they'll send you deals to look at and invest to play along with. Any last question? I think we hit everything on the chat on YouTube and Facebook. Anybody on the Zoom call? Last opportunity. We're kind of up against the hour anyhow. So no, not seeing any. So Whitney, just let's now talk about more the emotional side of it. You've had obviously tremendous success. I mean, to be congratulated in your career personally. I'm sure along the way, like me, you meet people who are struggling, starting out, have major setbacks, want to get on the horse. What's your best encouragement, or what's your best tool for somebody who's looking to get started on a path for accumulating wealth and building their real estate experience and trust? What would you where do you send them currently?
Well, I mean, this is one of the reasons why I do what I do at passiveinvesting.com. I do the master classes. I would encourage you to get plugged in there. I do boot camps, which are more kind of like hands-on. We spend an hour and a half together talking about a particular skill and building out skills, something a little bit more in depth than just like a regular podcast. I actually have a boot camp coming up this Friday that's on 2023 goal setting. Wow. So this is a fantastic opportunity if somebody is like just starting out, they don't even know like what they should be striving for, how to kind of organize their initial finances in order to start investing. I encourage you to go to that, sign up at passiveinvestingwithwhitney.com, or I'll just drop my email, whitney@passiveinvesting.com. Hit me up and I can send you that registration link for the boot camp. I don't think I spelled my name right. I don't have my glasses on.
No, no. Whitney@passiveinvesting.com, and I'll go.
Yeah.
There
you go.
It's your name, Whitney. It's your first name, Whitney. It's not that difficult. I'm sorry.
It is for me when I don't have my glasses on. But yeah, that would be kind of the first place to start is, getting plugged into a system for education to where you can feel confident about the questions you're asking, because there are no dumb questions. And I think that's where a lot of people kind of get intimidated. They're like, I don't want to sound like I'm unknowledgeable about that, especially if they come from like a real estate background or a finance background. You feel like you should already know this. You don't. It's like anything else. It's all entirely new language, new lexicon. Let me help you kind of like demystify that so you can go into an investment with confidence. So I'll offer that, as kind of a first tool. A second tool is just 3 simple questions that I always sit with when I'm up against an obstacle is like, what do I want? Why do I want it? And then who do I have to become to get it? And when I think in terms of who do I have to become, like I'm thinking of like, what is there a shift in my mindset? Is there a skill that I need to acquire? Is there a network that I need to get plugged into or bring somebody in my world? Or is there a who, right? Like you might just, sit with that, who do I have to become to get it, and come up with a laundry list of things that you have to, check off. But it doesn't mean you have to do all the work. You can, get connected with who's that can help you achieve the how. And so that's what I'm here for. I'm one of the who's that can help you, get started on your path.
Well, so the other who's, or one of the wheres, would be the LA County Real Estate Investors Association, which is our sponsor. And we host an event every second Thursday of the month in Los Angeles, live, real people. It's in the Culver City area. There's a map. If you go to LAREIC.com, there's about 250 people who show up. You'll meet other investors, other people like you on the path learning and growing. It's a vendors expo. I'm a vendor there, along with other friends. We try to help people on the path. And then we have a speaker. This week, This month's speaker is Bill Tan, been on a long time here on how to structure deals, fantastic service. So it's the second Thursday of the month in LA and the second Wednesday of the month in Ventura. So if you're interested in that, you probably are going to get invited to that. And if not, reach out to me and I'm more glad to share that information. Speaking of thanking Whitney, thank you so much for your insights today and your smile and your graceful way of talking about real estate investing. It's a scary topic for people, but yet you make it very inviting and make the first steps sound very possible. So I really encourage everybody to continue the path like I have with Whitney at passiveinvesting.com. Thank you for your time today. Really appreciate it.
Yeah, thank you so much. If I can help in any way, you guys reach out to me.
Thanks. And for everybody else, we do this every Tuesday, 3 p.m. Pacific time, 6 p.m. Eastern. We live stream it on Facebook and YouTube. It's recorded there as well. If you have questions, comments, put your comments or questions there. Love to see you. And again, we'll hope to see you a week from Thursday in Culver City area at LAProbate.com. Have a great week, everybody. Thank you so much.
Thanks, Bill. Thanks, Whitney.
Thanks, Whitney. Thank you so much.